here's one of the markets. This is simply the Crb Commodity Index. And it's been in a bear market since July of 2008 when it topped. And it's approaching, or has approached, 3-year lows recently. It had a little bounce for the past couple of weeks, but it's certainly been in a downtrend. And what is fascinating from our perspective is that this downtrend is occurring despite the U.S. Federal Reserve's feverish and historic quantitative easing. In other words, fiat money printing. And so what the Fed's doing is printing new money, dollars, yet that's not driving typical measures of inflation up, such as commodities and other markets that we'll be taking a look at. So the Fed has been increasing their balance sheet at about a 33% annual rate over the past 5 or 6 years, yet typical inflation hedges, such as commodities, are in a long-term bear market. And you can see that bear market right now. We don't think that bear market is over. In terms of Elliott wave analysis, typically markets will correct or go down in what we call an ABC fashion. You have an initial leg down, which is wave A, and you can see that in early 2009 on this chart. And then you have a counter-trend rally, which will be a partial upward retracement, which we label as wave B. Once wave B is over, you go down again in wave C, and usually wave C will move below the bottom of wave A before the entire bear market process is over. And so we've seen that initial leg down, that counter-trend rally, and now we've rolled over and are heading down to new lows. So this is one market that I think is really interesting in terms of commodities, and the truth that this market conveys is very interesting, and that is that the Fed does not control markets. The Fed does not control the inflation-deflationary process, because if they did, commodities would be soaring. Think about the inflationary periods of the 1970s, the mid to late 1970s, when the commodity markets were soaring, inflation was out of control, and you can see the opposite occurring right now. Now, the next chart I think is really interesting, and this is a neat chart that I don't think you're going to see anywhere else. And we publish this chart in our newsletter, the Elliott Wave Financial Forecast, in our January issue. Now, first of all, the Fed, U.S. Federal Reserve, is 100 years old. It was 100 years old 2 or 3 weeks ago. It started 100 years ago. It's a very fascinating book on how they started. But a lot of people don't realize this, but the Fed is not a government agency. It's not owned by the U.S. government. We call it a quasi-government agency. And that is, the Fed is privately owned by the regional banks, who are in turn owned by their shareholders. But the reason we call the Fed a quasi-government agency is because the president appoints, obviously, the Fed chairman and the vice chairman and so forth. So it's got this kind of murky status. But what's happened is that the U.S. government has contracted with the Fed and given them sole ownership of printing U.S. money. And so there's kind of this really interesting relationship between the two agencies. But the Fed is not a quote-unquote government agency. It's kind of separate. The top line of this chart shows the Federal Reserve's total assets. Now, you know about this. You've been reading about how the Fed has been trying to put money, pump liquidity in the system. They originally bought really bad mortgages when we had the credit crisis, and as of late, they've been buying U.S. Treasury bonds outright. But what you don't know is that the Fed's stated capital, which is on the bottom line, is only $55 billion. So the Fed has $4 trillion in total assets. A lot of that right now is U.S. Treasury bonds, but the stated capital backing that is only $55 billion. Right? When the credit crisis started, they were leveraged. Their balance sheet was leveraged 22-1. Right now, that leverage, as you can see in the upper right-hand corner, is 73-1. Okay? That's more than most hedge funds. And a lot of people don't realize that, but that's undergirding what's going on in the economy right now. And what's so fascinating is despite the Fed's leverage and their attempt to inflate throughout the economy, what's going on in terms of inflation, deflation? Well, this is the U.S. Personal Consumption Expenditure Index, core price index on a year-over-year basis. Basically, this chart is the Fed's favorite way of measuring whether there's inflation or deflationary pressures throughout the economy. And it's simply a measure of inflation at the consumer level. And personal consumptions contain data, for example, durable and non-durable goods, but it's mainly what's the consumer doing. And we have to really focus on the consumer because they're about 70% of the economy. And what's so fascinating is back in the inflationary period of the late 70s and early 80s, look what the personal consumption, U.S. personal consumption expenditure index was doing, the PCE. It was soaring as inflation was soaring. And then inflation, its back was kind of broken back in the early 80s, and we went from an inflationary period to a disinflationary period. And the PCE index, you can see, was falling during this whole period. But what's happened in the mid to late 2000s, we've had a historic, not only monetary stimulus through the U.S. Fed, but a historic fiscal stimulus through the U.S. government. Remember when we had that $800 billion TARP trying to push money into the system? And look what the PCE, the Personal Consumption Expenditure Indicator, has been doing. It's been scraping along the bottom. In other words, it's not inflation that we have to worry about. It is the deflationary pressures. And we're going to get into why there's deflationary pressures and the implications of that. But it's not just the U.S. I mean, this chart is the same PCE index, but we've overlaid that. That black line is Eurozone core inflationary measures. Okay? And you can see that it's not just the U.S. that are facing deflationary pressures and the implication of deflationary pressures, but the Eurozone and the European countries are in deflationary mode right now. In fact, they're farther along in this deflationary scenario than we are. And if you've been to my workshops over the last couple of years at these money shows, you know that's the theme that we've been pushing here. Everyone's been talking about hyperinflation and the Fed printing dollars and gold going to 5,000 and the dollar crashing. Our stance has been just the opposite, is that it's deflationary pressures that are overwhelming the economy, that gold is going to go down and the dollar was going to rise. And so far, that's been playing out over the last several years. And we're going to look at those markets as we go forward.